Hello students, welcome to EPG Pathshala. I am Dr. Anupama, Professor at Department of Economics, Punjabi University, Patiala. I am going to talk about the module Role of Private Individuals, Private Sector, Public Sector and Groups in Housing Finance from Population, Urbanization and Poverty. So students, we are going to discuss about the sources and importance of housing finance. We will also discuss about the role of private and public sector in housing finance. Housing not only provides physical shelter but also has significant impact on the lives of the dwellers in terms of skill enhancement, income generation, increased security, health, self-confidence and human dignity. Housing finance development, therefore, plays a role in boosting equitable economic growth and reducing poverty through helping households build assets, improving living conditions, empowering the middle and low-income population, and strengthening communities. Despite its considerable economic and social potential, housing finance remains underdeveloped in many developing economies. The residential housing sector of these economies is characterized broadly by a three-tier market. First are those households with the highest disposable income who are able to afford high-quality housing in fully serviced neighborhoods and able to utilize banking financing or specialized housing finance institutions. The second tier is the relatively narrow stratum of middle income households who are the main users of specialized housing finance institutions. This group is generally the major beneficiary of available public subsidies and is composed predominantly of public servants and wage or salary earners of large private companies and public sector corporations. The third and largest of the tiers is low-income households, for which housing is provided largely by the private sector, often under illegal and unsatisfactory site conditions. Thus, for an important segment of the society, the private sector, that is individuals as well as the institutions, play an important role in financing the housing needs. So, this module aims to throw light on the main sources of housing finance, why housing finance is important, how housing serves as an asset, the role of housing in economic growth, what is the role of private sector in housing finance, and what is the role of public sector in housing finance. This module will also aim to throw light on the role of community groups in housing finance. Let us discuss about main sources of housing finance. Housing finance is the provision of finance or capital for housing. There are three ways of interpreting this. Housing finance can be taken to mean the capital required for the construction of housing or housing projects. The resources required to acquire or access housing by households or the credit supplied by the housing finance institutions. To purchase housing, households might have to lay out as much as 4 times or even more of their annual income, and therefore few are in a position to buy a house from their own current resources. One obvious solution is to accumulate or save small amounts of capital and defer house purchase until the required total is reached. Even assuming that 20% of current income could be devoted to such savings, this procedure might imply a wait of 20 years or more, provided that costs do not inflate more than the interest accrued on savings in the meantime. Individual saving, therefore, is not a very attractive proposition. A way to overcome this is not only to use one's own savings, but also to borrow the savings of others, to acquire the capital to purchase a house now and to repay the borrowed amount back over time. For this, a group of prospective house purchasers could get together and pool savings. Provided not all the members wanted to borrow from the pool at the same time, we could have a workable system, and the larger the pool, the more workable it would be. This is, of course, the basis of mutual savings and loans associations that exist in many forms in many countries for a variety of purposes, not just housing. However, to get a sizable operation going, an association of savers alone will not suffice, and other savers must be attracted who do not have house purchase in view. Such savers need not only be the other households but may include institutions as well. Over time, a number of specialized institutions have emerged that can play the intermediary role necessary to run such an operation, bringing savers and borrowers together. Often governments provide incentives for savers to invest their money with such institutions, which makes them attractive. A large part of housing finance in the developed countries consists of transactions of specialized institutions in the form of building societies or housing banks. However, the impact of these institutions in developing countries has been rather limited. That housing finance institutions do not work well in developing countries can be mostly attributed to low levels and high disparity of income. Under such conditions, the sources of housing finance can be formal as well as informal. Low-income houses may depend upon the private sources such as relatives, friends, local money lenders, etc. The employers, community-based financing societies, the material suppliers, and the developers can also be important sources of housing finance, along with the housing finance banks and the nationalized banks. Thus, the key sources of housing finance can be private individuals, private sector, public sector, and community-based associations. These are shown in Figure 1. Now the question is, why housing finance is important? Everyone needs somewhere to live, and where they live is often a function of the money they have to pay for what is available. If a family does not have money to afford the cost of a former dwelling available for sale or rent, they will have to find somewhere else to stay. The role of housing finance is to make adequate housing affordable by spreading the relatively large cost of the house over a long period of time, so that each monthly installment is something that the household can handle within the scope of its own resources. Now we can discuss the main points highlighting the importance of housing finance. The first point is, housing is a fundamental human need and right. Housing finance provides common people relatively easier access to housing, which is very important need of one's life. Housing provides shelter for people to live in and space to carry on various activities of their lives. Housing also provides a fixed point which allows people to get access to basic services like water supply, electricity, sanitation, house registration, and citizen identification. Adequate housing is a human right, and the access to housing and terms under which they occupy that housing are important parts of a household's social status and important aspects of its members' well-being. The second point is that of expensive housing. Housing is expensive, and it makes sense to borrow to pay for the house we are living in. In some countries, a decent house can cost up to 10 times a household's annual income. Even under the most favorable conditions, formal housing will cost a minimum of 2 times a household's yearly income. Because the cost of housing is so high compared to what people earn, it would take too long to save up enough to buy the house with cash. Housing loan finance makes it possible for the household to get a loan and pay for their housing while they are living in the house. It makes the process of realizing adequate housing more efficient. Housing as an asset. A house should not be evaluated on basis of the cost of building only. For an individual, it is a social, economic as well as financial asset. This can be understood with help of figure 2. Housing is a social asset in that it provides a social safety net for family members. It contributes towards citizenship building by offering the resident household an address and linking them in with the local governance system. And around housing units, neighborhoods consolidate, providing access to all sorts of other social benefits, including networks, community support, and so on. As financial asset, housing is something which can be traded or against which mortgage finance can be accessed. When traded, the value of the transaction contributes towards a household's actual wealth and can then be reinvested in better quality or more appropriate housing for families' individual circumstances. Housing can be used as security against a loan for business purposes and suggested that this was an important strategy for low-income households to improve their overall wealth. Housing is also an economic asset. Housing can be an economically productive asset when it is used to generate income. The home is commonly used as a base from which economic activity is undertaken. For example, the household could borrow a housing loan to build an additional room on the property and rent this out to a tenant, or a family member could run a small shop from their income or offer a service which may further add to family's income. Housing finance and economic growth. Apart from these individual benefits, housing finance also have significant macroeconomic impacts. The relationship is quite simple. The availability of housing finance stimulates the demand for housing and triggers housing developers to build more houses. This stimulates the local economy in particular, as housing construction generally involves locally produced materials and labor. More houses encourage more people to buy them. Once these houses have been bought, they need to be filled with furniture, and many of these goods can also be produced locally. As the demand for more goods increases, the supply response creates more jobs, which creates greater affordability for more loans, more production, and more consumption. This virtuous cycle becomes possible in part because of housing finance. It also provides sustainable human settlements. In macroeconomic framework, the importance of housing finance as a tool of access to housing can be understood with help of figure 3. The figure depicts the role of housing in economic growth. Housing sits at the center of a chain of backward and forward linkages with other parts of the economy. Backwards to raw materials, that is wood, cement, iron, land, infrastructure, and financial services. Forward to so-called white goods, for example, refrigerators, TVs, ovens, furniture, construction, materials for home improvement, and so on. The construction, sale, and ongoing maintenance of residential housing are critical components of national economic performance. Of course, job creation is a fundamental output of healthy housing sector at all skill levels. Housing construction is a labor-intensive exercise, and an increase in housing delivery can lead to substantial job creation, both skilled and unskilled. The potential for small, medium, and micro enterprise development in the home improvements industry is also significant. This in turn contributes further to economic growth as working individuals become consumers with their additional income, creating greater demand for goods and services, and so on. Finally, it has long been understood that housing plays a critical role in the production and maintenance of sustainable human settlements. When housing is well integrated with the services and functioning of municipalities, it serves both to integrate individuals into the community and as a point of engagement with governance structures. Residents in sustainable neighborhoods pay rates and taxes and contribute to their municipality's capacity to deliver more services. Incapability of the government to provide universal housing facilities. While most governments would like to give all of their constituents houses for free, no country can afford such a large entitlement. Even in a country like South Africa, where the government has adopted a fairly widespread housing subsidy scheme, housing finance remains important for those who are not eligible for subsidies. In order to ensure that all of its people have access to adequate housing, a government must make sure that housing loans are available for all. Now we can discuss the role of different players in housing finance. As we have already discussed, there are four main players of housing finance. These are private individuals, private sector, public sector, and community-based organizations. In most of the developing economies, the existence of large informal sector has also led to informal sources of housing finance. Formal institutions of the housing finance have low coverage of population, particularly for low income groups. This may be due to failure in implementation of national policies aiming at encouraging domestic savings and development of domestic financial institutions and instruments. Lacking collateral, the guarantee of regular and recorded income, the low income groups depend completely on informal credit sources, which are expensive and mostly short term. As far as private finance is concerned, though the individuals in middle and low income groups have the capacity to save and purchase a house on their own, but a house eats into their lifetime savings, leaving little for other emergencies of life. Therefore, they also do not want to put their savings in one go. They need some financing agencies where they can pay in installments and keep some of their savings aside for meeting the contingencies of life. Thus, for individuals belonging to low as well as high income group, personal sources are generally not enough to finance the housing needs. This fact highlights the importance of institutional agencies to meet these needs. In this direction, both the private and public sector play their own respective roles. The role of the private sector. In recent years, market-based housing finance has come to account for an increasingly significant share of financial sector activity in many countries. A study by Chiquer suggested that for the developed countries, housing finance is now an important part of the financial system. It is also being increasingly important in many developing countries. Many of the developing countries listed in the figure now have mortgage debt in excess of 10% of GDP. A few years ago, most of these systems did not exist at all. The main reason behind the expansion of the private sector in housing finance is considered to be the liberalization of financial systems in the mid-1980s. Before this period, the housing finance was highly regulated and non-competitive. The result was that housing finance was available to a limited number of people who usually received government assistance of some kind. In the mid-1980s, all this began to change. Systems began to be deregulated, adapt and grow, and therefore the private sector assumed greater importance. Housing loans are particularly difficult loans for lenders to offer because they are bigger than most other loans, requiring a longer repayment period. This involves a lot of risk because the chances are greater that a borrower might default on the loan, that the property value may drop so much that it no longer matches the value of the loan outstanding, or that inflation may make the loan worthless. Long-term loans also tie up relatively large amounts of capital for long periods of time. This means that the lender can't lend that money out to other people. One of the biggest challenges facing any housing lender is getting together enough money to be able to offer loans in the first place. The private sector lenders are defined by the way in which they get money to lend. There are broadly three different approaches. Number one, as deposit-taking institutions, private banks lend other people's money. Secondly, contract savings institutions are deposit-taking institutions that specialize in housing loans similar to building society. Thirdly, mortgage banks fund their loan portfolios by issuing securities to investors. Out of these, the private banks perform their housing finance functions as normal lending operations in which they channel funds from the savers to the borrowers. When a saver deposits their money in the bank pays them a fee for keeping their money there. This is called interest. Similarly, when a borrower takes a loan from the bank, their repayment comprises the capital amount divided into smaller amounts payable on a monthly basis and interest. Housing finance takes this whole process to another level because housing is expensive. The purchase of a complete dwelling can cost as much as between 2 and 10 times a household's annual income, far beyond the saving capacity of most households. For this reason, most complete dwellings are paid for with loan finance, usually a mortgage, that borrowers then repay in manageable monthly amounts over time. Again, the bank has to make sure that the borrower repays their loan so that savers' deposits are protected. In industrialized countries, specialized housing finance institutions have lost most of their privileges, while some restrictions to their operations have been lifted as a result of the mortgage market liberalization policies pursued during the last 2 decades. Increasing competition among lenders may create more favorable conditions for lower income households to access mortgage credits. However, the mortgage loan is a highly formalized legal instrument which requires a clear title to the land, valuation of the property, and registration in a land register, all calling for costly professional help that the poor may be unable to afford. Furthermore, in case of less developed regulatory and legal frameworks for mortgages, the financing institution is not able to easily convert mortgage property into liquid funds in case of default by the borrower. It must enter into often lengthy and costly legal procedures before the property can be sold. Despite all these difficulties, the mortgage lending is assuming greater importance these days, particularly in the developed markets. An important indicator of mortgage-based housing finance is the mortgage to credit ratio. This ratio is a measure of the relative size of the housing finance sector and its ability to provide households with the funds necessary to smoothen consumption patterns over time. If mortgages form only a small part of total credit, it is likely that housing finance institutions are poorly developed or face legal or institutional constraints, making it difficult to meet the demand for housing finance. Least developed mortgage sectors are in Asia, transition countries, Arab states, and Africa, accounting for less than 10% of the total credit. Besides, there are specialized mortgage banks that offer mortgage loans. They raise capital by selling securities to investors, which are usually long-term financial institutions themselves, like pension funds or insurance companies. They also receive savings from ordinary people who buy insurance or pension products. Because these products only mature after a long time, the fund or insurance company knows that they can invest the money in an institution that also has long-term obligations. Thus, these institutions also offer an important source of housing finance. Now we can talk about the role of public sector. The role of government in housing finance is very important, not only in direct lending for houses, but also for creating a conducive environment that induces the private sector to invest more in low-cost housing. In inflationary economies, particularly in developing countries, affordable housing credit is difficult to obtain, even for middle and upper income groups. Many developing countries have therefore set up public sector housing finance institutions. These usually provide loans at interest rates below the market or even the inflation rate, using funds from budget allocations and captive savings in the public sector, such as the reserves of insurance institutions and the pension funds. The government's role in housing finance can take various forms, which can be enlisted here. Number 1, direct loans at the below market interest rates. Number 2, interest rate subsidies paid by the government to lenders to reduce the interest rate charged to the borrower. Number 3, mandates by the central bank or government that set interest rates on housing loans. Number 4, payment of bonus interest payments on contract savings schemes tied to dwelling purchase. Number 5, upfront or down payment subsidies. Number 6, tax advantages on mortgage interest payments. Besides, the government also plays a positive role by creating a transparent and comfortable regulatory and legal framework that deals with security and registration of land rights as well as the protection of the rights of lenders in case of mortgage finance. A well-designed land management and registration system can increase people's access to housing and credit considerably. The role of community groups. Over the last decade, savings and loan groups at the community level, supported mainly by the NGOs and international donors, have become increasingly important in financing shelter for the poor. These groups allow low-income households to gain access to credit as a community. When settlers organize themselves into stable associations, some of the usual financing criteria can change, where the community as a whole acts as a guarantor for the repayment of individual loans. Loans are secured by the many binding ties between the members, that is, the social capital. Social guarantees and peer pressures work particularly well in terms of repayment of the loans, as the community associations are more effective in collecting monthly rental or amortization payments from all members. The association keeps individual records of accounts for the monitoring of all collections and payments made by its members. An important example of such initiatives is Grameen Bank housing loans in Bangladesh. Experience has shown that communities where individual incomes are in the lowest quintile have an excellent record in loan repayment as well as wider coverage of the priority group, as these organizations have greater information at the ground levels. So students, let us sum up what we have learned from this module. So far, we have highlighted the need of housing finance to meet the most important basic necessity of mankind. We have observed that the individual sources of finance are not adequate for a large segment of the population in developed as well as the developing economies. Therefore, the formal sources of housing finance are very important in meeting the housing needs of the common masses. In this respect, the private sector, the public sector, as well as the community groups have their own roles to play. As the economy prospers, the private sector plays a greater role, but the poor economies with less developed market-based housing finance, the importance of public sector as well as the community group is indisputable. That's all with this lecture. I hope you must have enjoyed it. Thank you.